breaking news that we're not 100% sure it's legitimate. The darlings of the stock market this year are in for a real ride. That there might be a Ponzi scheme in the AI space involving companies like OpenAI and Nvidia, Microsoft.
Loan defaults could increase, force $23 billion in Bitcoin selling.
We will see a massive crash in the tech sector. So welcome to the Wise Money Guys radio show. I'm your co-host, John Scambram, here with my partner,
Giuseppe Visconti.
And if you don't know it already, we're certified portfolio managers that specialize in helping people who are retired or about to retire manage their money, create their plans, and just help them live out their financial dreams, specifically pre-retirement and during retirement. So as always, if you like our show, and I just stumbled on my words this Saturday morning, give us a call at 916-967-3500. But before we really dive in, I want to start off by saying we have breaking news that we're not 100% sure it's legitimate, but we're going to save that for a little bit later, that you absolutely need to know and hear, because if it's even half true, the darlings of the stock market this year are in for a real ride. And if we think about it this week, it's been a pretty good roller coaster ride already. I mean, I get it relative to
nothing,
the year to date, not that big of a deal, but relative to May, as you say, but still, this news is so juicy. And I can give you a hint. It's about one of the Mag 7 stocks that everybody loves. And again, it's breaking news. We've already seen movement. If you or anybody has this position, you're going to want to give us a call, come in and see us, because we can show you, especially if you have a lot of shares in the Mag 7, on how to strangle and straddle and hedge and protect that position and potentially lock in its value and still generate great returns from it. So, But
past performance doesn't predict future results. And you can look at more information, get more information from our website, wisemoneyguys.com. And we have a lot of cool information, tools, calculators. You can scroll all the way to the bottom, read our lovely and exciting disclosures, but also our bios, more about, John's background, my background. We talk a little bit about on the shows, but as well as a firm. You can also ask us a question. So if there's a topic or area that maybe we haven't talked about or is an interest of you, you can email us at question@wisemoneyguys.com.
I forgot to check this morning, so probably not going to get to questions today, but we will next week.
Yeah.
So definitely email us and we'll get to those questions. And we don't literally say, oh, this is a question from so-and-so. We just read what it is, and then we talk about it on the radio. So please don't be shy. We're not going to mention any name that you would give us or personal information. And we enjoy trying to, and we do respond, by the way. So we're going to answer your question right back to you via email. And if it's something really interesting, we'll talk about it on the radio, as I said, without actually bringing up your name or personal information. We never disclose personal information, and we don't sell people's information. And we have all of our clients, by the way. Have you ever noticed on like the Schwab applications, it's a double negative as far as they say opting out of
for Schwab
of information sharing.
Privacy.
It'll say something like, yes, I do not want to. Yes, I do not want to share my information, or no, I do want to share my information.
Yeah.
So I find that, and we make sure we have no marketing information from our partners like Schwab going to our clients. By the way, if you don't know, Charles Schwab is really our favorite platform that we do manage our clients' money through.
It's a custodian.
It's a, I'd say and compare and contrast it to Fidelity, and nothing against Fidelity. We also have clients in Fidelity, but
Right.
I like the Schwab platform better than the Fidelity platform.
The support that we get from Schwab is 10 times better. When we need an answer, typically we get an answer in 5 minutes or less, where it's 10 times faster than what we've experienced in Fidelity. Surprisingly enough, because we thought, Fidelity and Schwab are the two. Well, they're the two big behemoths in there.
Even better than Schwab.
Yeah, you would expect. I mean, I would expect at least the same.
Yeah,
because they're the two big behemoths, in the brokerage, at least the retail brokerage side of things. And we represent them on the institutional side. So we don't custody our own clients' money. Our clients' money assets are
very important.
Schwab, Interactive Brokers, Fidelity, Paychecks, and we use all these big names, and the money's there. We just manage on their behalf, put together the financial plan, albeit. But yeah, we're very surprised on the differences between the help and support that we get when needed from Fidelity versus Schwab. Hopefully it improves, but we'll see.
So what that really means is if you already have a Schwab or Fidelity account, giving us a try and hiring us to see why we consider ourselves probably the best in the region.
In the West?
Best in, I like that. It rhymes. The best in the West is pretty simple to do. So with that, let's dive in a little bit. Let's not.
We have
Nvidia.
We have Nvidia earnings.
Yeah.
We got to talk about.
Yeah.
We have some economic data that's coming out. We had non-farm payrolls, job numbers, essentially,
which were on pause because of the government shutdown.
Right. So we'll talk a little bit about that, unemployment figures, and then dive into the breaking news of just from some of the information that we've read, have not dug far enough to see if it's legitimate, truly legitimate or not, but it has a pretty good ring to it.
Well, here's what it does. It really makes you be cautious. And so what I like about this that we're going to share is it's just a demonstration of we just don't blindly, put money into specific positions
because it's shiny
without following the news, looking at technicals, looking at financials, trying to get our hands on various things to make a decision if it's time to get out of something and get into something else, or if it's time to add something. Don't forget that for the last 2 months or so on this show, we've been telling people, be cautious here. Don't go betting the farm on the tech sector.
Yeah, be choosy.
Be choosy, and gosh, lock in profits and regret that you locked in some profit and you might have made a little bit more money on paper versus you didn't lock in profits. And now you've watched some of those profits go up in smoke because you mentioned Nvidia earnings. And you look at Nvidia, broke above 200,
crushed it,
and now it went down into the 170s. I didn't look how it closed on Friday, but I mean that's a 10% swing right there. And if you didn't lock in some profit, you potentially gave up 10%. And so
well, and I don't think that's a direct reflection of the earnings because they crushed earnings once again.
Crushed is an understatement.
Yeah. So, and after hours, when they reported, the stock was up after hours 5%. But then the following day, everything was up, on Thursday, and then things just started breaking apart and then went down. We had some Fed speakers, job numbers came out, so that poured a little bit of cold water on the betting markets as far as are the Fed's going to cut rates or not. It was like 90%, then it's 50%. Now it's in the 40 percentile, I think maybe even lower if the Feds are going to cut another quarter point in December when they meet. So that put a little cold water on the market. And then valuations, which surprisingly, it's maybe the past 3 or 4 weeks, I've been seeing headlines, and it's just so funny because I'll see the headlines obviously every morning, and it'll say stock market's up, and then it'll give some sort of description of why the market's up or why the market's down, right? But now you've been seeing these past at least few weeks of why we've had some volatility, especially in the tech sector, of valuations.
Yeah.
Well, there was no headlines of valuations when Nvidia was $200 a share or anything.
Exactly.
But they're 180 a share or 170 a share.
Now they're concerned about the valuation. Yeah.
after they crushed earnings.
Well, you know what else is interesting, and it's kind of shocking actually. We talked about this during the week, is that Microsoft and Nvidia, if you take either one of those two stocks, that the market value is bigger than all other stock markets in all the other countries except for China. And that is just unbelievable.
So China or Japan?
Except for Japan. Okay. Thank you. And Apple by itself is as big or bigger than the entire Chinese market cap of their stock market. Yeah. So, and those three companies are here. So that just tells you, if you're not investing or if you don't think that the U.S. is still the land of the greatest opportunity to live and prosper, just from a financial perspective, boy, it's not somewhere else. That's for darn sure.
Well, there are other companies, emerging markets and internationals actually had a pretty decent year so far this year.
Yep.
But everything is so connected these days. I mean, like Apple, right? If China has bad news on manufacturing with Apple, so obviously, but it's crazy.
So much manufacturing in China.
But to your point, when the U.S. has something material going on, whether it's the Federal Reserve or Nvidia earnings or whatever, and we have a down day, Asian markets will open up, later on the same day at night, in the U.S., and they have a down day. And the description, the headline is not what's specifically in the Asian markets, but it's because what happened in the U.S. markets or U.S. companies.
All right. So on our next segment, we are going to break the news that we've been talking about. We're prefacing it with, again, news. There's no, well, I guess for a while there was things that would say, oh, fake news, and they turned out to be fake. But even if this segment is half
something to think
true,
about.
Something to heed caution on. So we'll spend time talking about that in our next segment. You absolutely have to stay tuned and keep listening to the Wise Money Guys. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambra. I'm here with my partner, Giuseppe Viscani. And just real quickly, before we dive into the breaking story, tell us about the job numbers. Because, again, those are crucial when it comes to the Fed's decision on whether to lower interest rates. Because we're actually seeing the long side of the yield curve in treasuries creeping up. So people always think that, the Fed cut rates. That's it.
Cheaper,
you cut Fed funds and automatically interest rates go down. Now we have seen improvement in mortgage lending rates, and the shorter side of the curve, which is a normal yield curve, has gone down a little bit. But it's concerning that the long side of the curve is actually going up, which means people are selling out of longer dated treasuries, and
all that means to the regular retail citizen out there is Fed cuts rates, the 10-year treasury is kind of the barometer that initially dipped down. You saw mortgage, 30-year mortgage rates start to decrease, car loans start to decrease, but then they started creeping back up again. And so that's why if these, the 10-year yield treasury starts creeping back up again, it doesn't matter if the Feds are lowering rates. They did this in 2024 where they cut rates 3 times. And just before they cut rates, we saw mortgage interest rates, start to dip. But then after the cuts, they actually spiked back up and then went back to like 7%. So it didn't really help anybody out. And so that's where that can be very important to watch that number and where the 10-year treasury is, because it doesn't matter if Feds cut rates. Initially, people think, I can go get that loan for that car, or maybe I can go afford that house now because it's, 0.25% lower. No, it doesn't actually translate directly like that. Yeah. But what it does directly translate to is the CDs, the money market rates, the savings rates, those will come down immediately when Fed start cutting rates. And that's where you have to pay attention to as well, because then how are you investing your money? You know, if you're earning 4 or 5% on some promo money market or CD rate, that's great. But especially CDs, and we had a meeting with a potential client, and they had 3 14-month CDs that were locked in at 4.25, which 4.25 is pretty good right now. The problem is when they mature, when that 14 months is up, what are rates at? What are rates going to be at that point in time?
3 or sub 3.
And now, and the discussion that we had with them was, well, you can get into, JP Morgan or Wells Fargo, or these other banks that are offering these CDs or money markets, right? Promo, higher rates. You can get into their bonds right now. They're paying 5 or north of 5, but it's not going to be that, 14 months if everything starts to go down. But to the job numbers, data came out in September, non-farm payrolls. So basically employment increased by 119,000, much higher than what was anticipated. It's good news, but the good news
in an upside down world, right? It's inverse good news. And I used to talk about this a lot lately, that or recently, that bad news was good news when it came to decisions that we wanted the Fed, the central bank, to make. And that's kind of where we're at.
Well,
now.
that was partly, after April and May, when the market, corrected over 20%, market started rebounding because AI euphoria was starting to come back. But then more so, it was the Federal Reserve was in focus, and the rate cuts, and them taking a stand to just leave rates, stand pat, to now having a discussion of like, yep, I think we can start cutting rates right now. And so that's a stimulus to the overall market. But if you have good news that the economy is resilient and it's still doing good and it's strong, then that means that it's not giving much ammo for the Feds to continue to cut rates. Therefore, there's no more of that stimulus that is going to be fed into the stock market. And we're seeing a little bit of that, and why the volatility is kicked in recently into the stock market. So I take it as good news, because it just means that we're still being resilient. On the other side, what you're going to get excited about here, John, is unemployment rate rose from 4.3 to 4.4%. You're going to ask, well, why? If we had stronger numbers in September than what was expected, how did unemployment go up? Well, partly due because of BLS revised the numbers in August from positive 22,000 jobs to negative 4,000 jobs.
You can't trust government data. I mean, this game of basing things on bad data, which mostly is political narrative data, is just, it's ridiculous. That's why you need people like Giuseppe and I to actually dive into the investment, the portfolio, be at the helm of potentially making changes by knowing the underbelly of these things. And you just can't blindly, trust. I guess the saying has always been trust but verify. Boy, I think it's hard to trust, yeah, and double verify, because the numbers just aren't, ever correct. And they base these numbers, on decisions, or they take these numbers and base their decisions on them. And it just drives me nuts.
But it's hard to, if you got to revise it. Yeah, especially the revisions has been more biased to the downside versus the upside. So it is hard to trust. And it's funny, I just watched a movie last night. I was just up and was on YouTube TV, and a movie popped up. I'm going to see if you know this movie. Okay. You got to know this movie for your Italian background.
I may.
But it talked about, but part of that movie was all about trust.
Yeah.
Right. And it was a world where this kid was living in between and trying to live by his father, who was a hardworking blue collar worker in the Bronx. Yeah. But then he lived next to a bar, right, that had the mafia.
Yeah.
And the head boss, or the captain, capo of that region, took a big liking to this kid.
Was it Al Pacino?
No, the kid.
No, not the kid, but the father.
No, it was Chaz Pilamentary.
Oh, okay.
And the kid's name was Calogero.
Uh-huh.
So that should give a hint. But it was all about trust.
What in my mind was Bronx Tale right off the bat. Yeah,
exactly.
That's a great movie.
But it was all about you can't trust nobody.
No, and you can't trust. Sadly, you can't trust the data. I mean, that comes out of these, like the Bureau. You mentioned BLS, by the way. That's Bureau of Labor Statistics. You can't trust their data. You can't, they and politicians always tout, according to the CBO or the BLS or the federal or the FRB, Federal Reserve Board, on and on and on. What you can only trust is what you see in your results. And that is where we are your warriors to make sure that we know and have created the plan that you need. And we know and have created the investments that you have. And we know when, and again, we're basing it on what we can dig into. So that's kind of a good segue to dig into this breaking story, which is on the darling Nvidia. And I mean, I got chills when I read. Now, you all, who's ever listening may be familiar with, just recently we had a Ponzi scheme, with the crypto exchanges, right? And you had, I forget his name, that's now in prison because they were, taking some people's money. And
FTX,
and that was coming. Yes, FTX. Thank you. Taking it in and saying that money coming in was return on investment. That your investment, and then they were paying out people, on that new money that was coming in. And so, which is what a Ponzi scheme really is, until the money stops coming in. And then now people who want to get their money out have no money to get out. Right. Because they find out that the returns and the performance just really weren't there. So it's the classic definition of robbing Peter to pay Paul. And so, listen, the Mag 7 has had a tremendous year, unbelievable returns, and everything has been years about AI this, AI that. And we've spent a lot of time trying to find indirect ways like energy investments, software investment, data centers, or the people who literally physically construct those things, on ways to play AI that just weren't, the chip or the software or the machines or the quantum computing and things, like that, because, things were getting lofty. And go ahead and share what you sent to me that literally gave me chills, because as we said, this breaking story, even if it's half right, even if it's a quarter right, the pressure it could be put on the valuations of everything having to do with AI and the increase in profits that has been told to us. Within, if any of that becomes untrue, we will see a massive crash in the tech sector. So if you don't have somebody who's in your corner watching these things, making sure you're properly diversified, making sure that all your investments aren't tied to one sector and one category investments, i.e., stocks in the tech sector, boy, you could be in for a world of hurt. You're going to want to call 916-967-3500, but share it, Giuseppe, because like I said,
we don't have much time left in this segment, but
so we'll get to it in the next segment.
But the glimpses, we've already talked a little bit about OpenAI, because there's been a lot of investments between OpenAI and other companies, Oracle being one of them, and $300 billion. And we were kind of questioning, well, if they're investing $300 billion over 5 years in Oracle, how much are they actually making in revenue now, right? And they were like negative, and I think they were slightly positive. Well, how are they going to get $300 billion to Oracle, right?
Excuse me. Yeah, how do you get $300 billion in Oracle purchases when your revenue is $13.5 billion? Nobody's going to or negative. Nobody's going to lend you, $280 billion. But we're gonna tell you more about that. You absolutely have to stay tuned. Keep listening to the Wise Money Guys. We'll be right back. Welcome back to the Wise Money Guys. I'm your co-host, John Scambra. I'm here with my partner,
Giuseppe Visconti.
And the story we've been alluding to, we didn't break the news, but we're certainly diving into it and trying to corroborate it with more research and evidence that we can find. But
it's like we're investigative journalists.
Well, I mean, you have to be. That's actually a really good point. I mean, when you're somebody's money manager, planner, financial consultant, and you help them with something so significant as their wealth and legacy and retirement income, so on and so forth, you have to be investigative journalists.
You're like Lois Lane,
right? But that's what always drives me crazy, that so many people are worried about paying a small fee, and our fee on average is 1% per year, and generally it gets paid.
It's actually our average on our.
It's actually less.
Our overall whole book of assets that we manage is actually 0.93. And because it can range below 1%, it could be above 1%, depending on the assets and household that we manage.
Yeah. And so many times when we take over somebody's portfolio, again, we're getting sidetracked, and we find that they have mutual funds and closed-end funds and ETFs and all these things, and then we show them what the embedded management and fees, expenses are inside of those. Often they're as much as our fee. And so when we build them a different portfolio with positions like individual bonds and individual stocks and alternative investments and so on and so forth that don't have those things in them, sometimes we pay for our fee just right there.
Right.
So, and that's analysis we do when you sit down for a no obligation consultation, and we review your portfolio and your situation, and we show you, how we do things and how it might be better for you. And just have a great,
basically how to get you from point A to point B, which is also part of the planning phase as well.
Yeah. But we've been dodging it. Okay, so here it is. I mentioned just briefly that there was a couple of Ponzi schemes. The last one was the crypto exchange Ponzi scheme. Obviously, everybody knows the Bernie Madoff one before that. But here we are, that there might be a Ponzi scheme. This is the news, that there might be a Ponzi scheme in the AI, space involving companies like OpenAI and Nvidia,
Microsoft,
so on and so forth. So if you have those in your portfolio, you absolutely need to come and see us, and we'll show you how potentially building you out a portfolio for now and in the future is just crucial, and you can't just rely on such a small segment of the investing world to be your lifelong.
It's actually pretty large though.
Well, meaning small in number, 3 companies, 5 companies, 7 companies.
Yeah. But it's crazy how small
income investments or dividend paying investments, because none of those stocks pay any dividend or any.
Apple does.
Oh yeah. What 0.79%? So, which almost pays for our fee, but here it is, tell.
Yeah. So
what we
say Ponzi scheme, but it's not a Bernie Madoff scheme, there was an article, there was actually something on X that was interesting. I read through it. It was sent to me by a buddy of mine who's also an advisor. I sent it to John, and, we'll have to look more into it to see the validity of it. But Nvidia accounts receivable.
It's crazy.
Go Nvidia's accounts receivable, right? So all the money that should be coming in exploded to $33.4 billion. But here's the important part of it is customers are taking a longer period of time to pay up. It was 46 days. Now it's 53 days, which represents to pay up, what they basically committed to Nvidia, whether it's chips or what have you. And so there's $10.4 billion at risk that could never be collected. Who knows?
Which would drastically alter their results.
Yep. Nvidia is sitting on almost $20 billion of unsold chips. So it's contradicting to the insatiable demand that they put out there on their earnings calls, and how much demand they have when they have this kind of
backlog.
Yeah, this backlog. Well, not only backlog, but the stock, stockpile. And it could be because they've been spoken for, and it's been accounted for in their Excel spreadsheets, with the bean counters, but not paid for, so therefore it cannot be released, right? So just kind of stockpiling. Nvidia reported 19.3 billion in profit, but only 14.5 that was in real cash, which is a conversion of 75%. The peers, when you're looking at amongst peers, the peers are at 95%. So there's some concerning things that are going on
in the accounting.
Yeah, in the accounting portion. The big thing, which is like the potential Ponzi scheme,
yes,
is the loop of companies that are funding each other, right? Microsoft, OpenAI, Oracle, Nvidia.
It's a circle revenue.
Yeah,
Ponzi
they're calling it vibe revenue, where dollars circulate between each other. Like, oh, OpenAI is going to commit to $300 billion of investment with Oracle. Oracle is going to, commit X amount of billions of dollars to buy X amount of chips over the X amount of years, with Nvidia. Microsoft is going to, commit to Oracle. Oracle is going to commit to Microsoft over X amount of years and X amount of purchases of product or service or whatever. But no, there's no true end to customer demand. And so does this, and so like the point that we brought up was like OpenAI, OpenAI themselves, let me see if I have data, because I did read, they had, OpenAI, here you go. So OpenAI loses $5.6 billion annually. They lose.
Yeah, they're generating no revenue
while making enormous forward purchase commitment. So, and that was what we had talked about, I think maybe a few radio shows before, when they announced a $300 billion. I'm pretty sure it was a $300 billion investment commitment to Oracle, and then Oracle literally jumped up their stock price to like 26%.
Oh,
now it's come down.
Oh, yeah.
Since then, but it literally spiked their stock price way up. But now you're saying, okay, OpenAI, Oracle, Microsoft, Nvidia, and they're all kind of committing to each other. And this is like kind of the side argument, and some of the people on the other side of the table saying like, oh, we have all this investment, that Trump has committed countries or companies, trillions of dollars, but has it actually come to fruition?
Yeah.
Right. The same argument is going on right now with all of this investing, future investing, not, hey, we gave you $300 billion, give us your product, or give us your product when it's available. It's all this, we're committing
it's
to
on the come.
Yeah, it's kind of like a LOI, right? We intend to invest X amount over the next many years. And because of that news that's circulating around, it's pumping the stock prices up.
Exactly.
Which then starts to become a valuation problem, which now you're seeing in the headlines in these past few weeks, but we've been talking about it before then, right? Even though the stock prices have been coming down with volatility. And then you have on top of it, the Feds potentially, it was like a 90% probability that they're going to cut a 0.25% rate in December. And now it's less than 50% chance.
I can't tell you how often we see people just get overcommitted to one stock because what it's done in the last few years, and never diversify because they don't. Here's the classic. They don't want to pay capital gains tax. They don't want to, lock in any of that profit, because think of the silliness of that. Okay. So let's say you were one of the people out there, and there's many of our clients that have made tremendous amount of money on these names, like an Nvidia. I mean, 100%, 50%, 500%, 1,000%. And you're going, no way, I'm going to make more. I'm going to make more. And besides, if I sold right here, I'd pay, tax
20%.
Okay.
Taxes.
But don't forget. So let's say you started with $100,000 in these positions, and now it's, $500,000. Okay. But then you watch it go back down to 200,000, giving up $300,000. I can promise you, your tax isn't going to be $300,000 on a $400,000 gain. It might be $100,000.
290,000.
Right.
No, I'm joking.
No, but the reality is that
could be a third.
We're in a very dangerous time right here on these valuations of the AI. And I don't want to say it's a bubble necessarily, because the infrastructure spending to support, this fourth industrial revolution is real dollars, by the way. the building into and the investing into energy and infrastructure and raw materials and rare minerals and so on and so forth. But that's real.
But are the prices of the stocks baking all that future optimism in a little too soon?
Yes. So this is where the key is true diversification. Don't think if you have mutual funds, oh, I've got this tech fund or this international fund or this growth and income fund, and we look at so many of these that just completely overlap. They're perfectly correlated. They a lot of times have the same top 10 holdings, just in different percentages. And boy, let me tell you, if the shoe drops, you will see, that 50% profit, that 100% profit literally can go away overnight. Please give us a call. Don't let that happen to you. It's not worth it, because even if you have to pay tax, you still are locking in a record amount of money. Now, I'm not saying, gosh, sell everything. No, we believe in stocks, but we believe in proper diversification. We believe that there's opportunities in many different ways. We found great investments this year in the alternative strategy space that are low correlated to stocks.
We just created another custom structured investment that's going to trade next week.
We found great. Exactly. We have another custom structured note that we're placing people in next week with an 11.25%, 10.5% annual dividend. That we'd love to explain more to you in a personal consultation. We have great low volatility investments, such as different real estate positions, different structures that have even a lower volatility measurement to bonds. So you'd absolutely need to give us a call. It's crucial, especially setting yourself up at the end of this year for a great year next year, because so often how you start the year is indicative of what type of year you'll have.
I've heard that before.
You've heard that before. So call 916-967-3500 and keep listening to John Scambray and Giuseppe Viscani, the Wise Money Guys. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray. I'm here with my partner, Giuseppe Viscani, and we need to clarify a little bit of what when we dive into the weeds. Okay, so let's say that there is this almost like a shared revenue being traded around, several companies. What would that mean to a company like Nvidia potentially and their stock price? I mean, we've got a little bit of analysis on that, and that's where I really got just scared, because how many people are just sitting on millions of dollars, and billions of dollars in profits on the Mag 7 stocks like Microsoft and Nvidia, on crypto like Bitcoin, and what it could do to both of those. Again, we're just digging into this. We don't know how much of this is true, but some of the data supporting this thesis.
Well, just taking OpenAI by itself, right? OpenAI
could be true.
OpenAI, we're seeing, you see the numbers on OpenAI as far as the profits and losses that they're making. So you have OpenAI as kind of an example of that. We've mentioned Microsoft, OpenAI, Nvidia. Nvidia's got a lot of profits. Microsoft's got profit. Google has a ton of cash, right? Apple cash. So, but you have like OpenAI, where they announced their investment commitment to Oracle, and then Oracle jumped by 26%. Since then, it's come down. But it's just, okay, you have a $300 billion commitment, but you're not profiting $300 billion yourself. Right?
Exactly. I mean, just
so then it's the prospect of, oh, well, then over the next 5 years, like OpenAI is going to be profiting, and they're going to definitely, or maybe they do through ownership, right? Equity interest. Nvidia takes equity interest in, Oracle and OpenAI, whatever the case may be. But if, like you said, all of it or part of it, a big portion of it is true, then you'll start to see this unravel. And then these lofty valuations that these tech companies which we've already seen starting to pull back because of valuation concerns, that'll just continue on. And it could very well be something like what we saw in April, which was a catalyst of the Feds, right, coming out. Well, not the Feds, I'm sorry, the tariffs, coming out, but then also DeepSeek, where we had DeepSeek come out and said, oh, they spent, so many millions of dollars on
versus billions
instead of billions and hundreds of billions of dollars, right? And we saw these names go down by 40% more,
50, 60, 70%.
So it could easily, turn into something like that, just because after April and May, I mean, if we think about it, look, after April and May, what has fundamentally really changed with the AI space? They've advanced some things and maybe some new chips are coming out, but other than that, I mean, it's been pretty much the same. I haven't seen
still the revenue generation from AI didn't increase at the same rate that stock prices increased.
That's my point.
Because they're betting, again, like you've said earlier, on the come, not on the actual revenue and profits and earnings that are happening now.
Exactly.
And that's the scary thing.
And you're seeing, some market signals and some big investors out there. Thiel, SoftBank, Michael Burry has been on the news recently.
One of the big contrarian and short sellers has bought puts on a massive scale on Nvidia recently.
Michael Burry?
It's somebody like that.
Yeah.
Again, don't quote me on who the exact person
I think but Burry did a lot of
call volume is one of the things that I look at, is definitely really skewing on the put side versus the call side. So that means that's a bearish indicator, not a bullish indicator.
Yeah. But there's also a big correlation with Bitcoin and cryptocurrency, and you've been seeing cryptocurrency having a pretty big pullback as well. I mean, Bitcoin's gone down, I think 20 something percent, almost 29% at one point. And that could be another risk too, where if there's some unraveling of some of these AI speculative, pricing in some of these stocks, that can tie into Bitcoin, and Bitcoin itself can have even a further pullback. So if Nvidia, for example, drops like 40%, like it did in April and May, loan defaults could increase, force 23 billion in Bitcoin selling, and then that could bring Bitcoin price of Bitcoin down to $52,000. So, like we said, we're not saying this is 100%. It was an interesting read. It was something that caught our attention. We'll do some more digging.
Portfolio managers do versus advisors do. Advisors typically sell you stuff. Portfolio managers are responsible. Planners, portfolio managers are responsible for creating your custom portfolio, actively managing that custom portfolio, making sure that you have true diversification, which is focusing on correlation, not just different brand of different investments and I'm in this stock and this bond, so automatically I'm diversified.
Well,
there's so much more that goes into
funds.
Portfolio management.
More so funds and mutual funds, like you said, because there's a correlation, and sometimes they have the very big names that we're talking about. And why do they do that? Well, because the portfolio managers and fund managers, they want to get bonuses at the end of the year. And how do they get bonuses? Because they need to outperform their benchmark, or at least keep up with a benchmark. Well, how do you keep up with a benchmark or outperform it? You got to have the very same names that are driving that benchmark. And what drives the S&P 500? Well, 34% of it or more is coming from the Mag 7 names. So if you don't have Mag 7 names and you're trying to beat it with the other names in there, good luck. It's pretty hard to do. And then are you gonna take that chance to be the magic picker out there and beat the market and risk your annual bonus on that? Maybe not. Probably. So that's why when you look at T. Rowe Price Growth Fund, Fidelity Growth Fund, Vanguard Growth Fund, all those growth funds, you're going to have, you say, hey, top 10 holdings. You look at the top 10 holdings and open up the hood. And those top 10 holdings usually are very similar amongst one fund to the other fund.
So let me put it simple. If you have $250,000, $500,000, $1 million or more in mutual funds, my first question is why? My second question is, why aren't you meeting with your advisor and giving us a call at 916-967-3500. We will absolutely do a free review. We're not going to beat you up for what you have, but we're going to point out, things that we know and that we can see that might be areas of concern. And we'll do that with absolutely no obligation by calling 916-967-3500 and getting on John Scambray and Giuseppe Visconi's calendar. Hope you enjoyed the show. Have a wonderful Saturday. We'll talk to you next week.
Have a great weekend.